Gurmir Singh.
And I'm his partner, Christopher Vaughn, and here is our stock pitch on Alphabet, Google's parent company with the ticker GOOG.
Alphabet Inc., as stated before, is the parent company of Google, along with several other businesses such as YouTube. Google was founded in 1998 and YouTube in 2005 before being bought by Google in 2006. Google and all of its subsidiaries were bought by Alphabet when it was created in 2015 as part of a corporate restructuring to make the core Google business model more streamlined while giving other ventures room to grow. Google remains Alphabet's largest and most profitable subsidiary, driving the majority of revenue through search engine, YouTube, Android, Google Cloud, and advertising platforms. This structure allows Alphabet to pursue innovation at a large scale and investing in long-term projects without compromising the focus or efficiency of its core business. As of today, Alphabet stands as one of the most profitable and recognizable companies in the world, playing a leading role in AI, cloud computing, digital advertising, and next-gen technologies.
Industry analysis next. The digital advertising industry has shown consistent and impressive growth. From 2014 to 2019, it grew at a compound annual growth rate of 10%. Looking ahead, projections show an even faster growth rate of 14% annually over the next 5 years. In terms of market value, the industry is expected to be worth around $1 trillion in the near future. Regionally, North America leads the global digital ad market, holding about 40% of the shares, followed by Europe at 30%, then Asian Pacific region at 20%. Google, Meta, and Amazon dominate this industry. On the cloud computing side, which significantly complements the digital ad space, the market is also booming. And according to the Cloud Computing Global Market Report of 2025, the industry will grow at a compounded annual growth rate of 15.5%, increasing from $735 billion in 2024 to nearly $1.5 trillion by 2029. These trends highlight strong industry tailwinds, especially for companies like Alphabet. Investment thesis. Our investment thesis is very simple. Alphabet is one of the most undervalued growth stocks in the market today, and we believe it is bound to benefit from the massively ongoing AI boom. At the heart of Alphabet is a safe foundation, which has been established itself, Google Search. This continues to generate strong, reliable cash flows, offering financial stability even as the company invests in what may be risky next-gen technologies in AI. Where the real growth lies is in AI. As the AI space continues to grow, Alphabet is not just participating, but it is leading. The company is pouring resources into AI development with Gemini at the center. This position is Alphabet's uniquely, with a balanced profile of low risk, steady returns from its core business, and high upside potential from AI innovations. Based on our analysis, we give Alphabet a 12-month target price of $220, reflecting strong fundamentals, but also high growth potential.
Competitive positioning. Alphabet stands out across multiple strategic dimensions. First, it operates as an integrated ecosystem. Search, Maps, YouTube, Android are all interconnected. This synergy allows Alphabet to collect rich user data, improving both and targeting a user experience, making it more enjoyable and more catered. Second, Alphabet benefits heavily from network effects. As more users engage with their platforms like YouTube and Search that are interconnected, it helps them provide better, more quality data. Third, economics of scale. There are major advantages for Alphabet's global infrastructure. Custom-built chips, massive data centers, high-efficiency networks. This lets them deliver top-tier services at a low marginal cost, which is hard for most, if any, competitors to match them with. On the right, we can see strategic threat radar, in which we can clearly see that Alphabet does not have any major risks. Revenue drivers. This data clearly shows that Alphabet has three primary engines, being Google Search, YouTube Ads, and Google Cloud. Google Search remains the company's largest revenue source, generating $54 billion in quarter four, up from $48 billion the same quarter the previous year. Gemini is the main reason that this happens, because at the top of each search you can see the Gemini overview. YouTube Ads. They rose 14% year over year, reaching a staggering $10.5 billion in quarter four. Google Cloud is the fastest growing segment of Alphabet, expanding 30% year over year from $9.2 billion to nearly $12 billion now. This growth is driven by an increased demand for AI, which Alphabet is providing. Altogether, these segments pushed Alphabet's total quarter four revenue to a staggering $96.5 billion, with annual revenue reaching over $350 billion, reflecting nearly 14% year over year growth, the strongest top line performance since 2011.
Next is our valuation. We decided to take a more conservative approach regarding our key assumptions. Regarding our valuation, we used a discounted cash flow model to estimate Alphabet's intrinsic value. We project a 12% annual revenue growth rate over the next 5 years, which is realistic given Alphabet's historical performance and current AI momentum. Beyond that, we applied a 4% terminal growth rate, reflecting long-term sustainable expansion. We also used a 10% discount rate, which aligns with market norms and accounts for Alphabet's risk profile and cost of capital due to its large investments. On the cash flow side, we assumed an 8% free cash flow margin going forward, slightly below the historical highs to stay on the cautious side. With these inputs, the model yields an intrinsic value of $164.80 per share compared to the current price of $158.32 on April 2nd, suggesting our company is currently undervalued by 4.1% compared to the true value. This shows that even with conservative assumptions, Alphabet remains undervalued, offering investors a stable foundation with room for upside, especially as AI-driven growth accelerates. Alphabet being currently objectively undervalued based on its intrinsic value, paired along with its high growth potential due to its large capital invested into AI, makes us extremely bullish on the stock, and that's why it's our top buy. Next is growth. Alphabet's growth story is driven by a combination of technological innovation, platform diversity, and strong execution. First, the company is rapidly integrating AI across its core products. Platforms like Google Search and Google Cloud are now powered by generative AI, which not only boosts user engagement but also boosts productivity and opens new streams of monetization, especially with tools like Gemini's AI features. Second, Alphabet benefits from a diversified monetization model. With revenue coming from advertising, cloud computing, hardware, and subscriptions, the company is positioned to balance steady income with high growth opportunities. This diversification strengthens Alphabet's resilience even in volatile markets. And third, Alphabet has shown steady historical expansions. Revenues have grown nearly 4 times in under a decade, from $90 billion in 2016 to $350 billion in 2024. This remarkable trajectory reflects consistent demand across geographies and strong operational execution. As shown in the graph, Alphabet continues to deliver double-digit revenue growth in quarter 4, recently hitting a 13% year-over-year increase in quarter 4 2023, signaling the company's growth engine is far from slowing down. Next is investment risk. While Alphabet presents strong upside, it's important to recognize key risks. The company plans to invest $75 billion into research and development in 2025, heavily concentrated in AI. While this could drive future innovation, there's no guarantee. Regulatory pressure intensifying. With regulatory pressure intensifying, particularly in the US and the EU, antitrust actions are potential business model changes that could affect long-term profitability. Next, Alphabet is heavily exposed to ad market cyclicality, with about 75% of its revenue tied to advertising. Lastly, in the cloud segment, Alphabet faces tough competition from AWS and Azure. Despite their rapid growth, maintaining margins remains a challenge due to the high volatility of the space. These risks don't overshadow Alphabet's strength, which is why we still have it as a top buy.
ESG rating. Alphabet is considered a high ESG performer globally with at most medium risk and remains committed to long-term leadership in areas such as environment leadership, social commitment, and governance strength. Alphabet ranks in the top ESG quartile, reflecting strong performance across environmental, social, and governance pillars. Environment leadership. They've been carbon neutral since 2007, aiming for 24/7 carbon-free energy by 2030. Investments in sustainability infrastructure, including AI-powered data center coding, and along with one of the largest corporate clean energy buyers, adding nearly 3 GWs of capacity in 2022. Social commitment. Champions digital inclusions and supports global computer literacy is brought to you by Google. Over $1.5 billion in philanthropic grants in 2022 for equity, recovery, and resilience. Strong employee engagement, though, and through paid volunteer time and donation matching. Their commitment socially is easily recognizable. Governance strength. It enforces robust ethical guides, frequent training, and clear reporting structures. There's improving board diversity and oversight despite past dual share criticisms, and they also are leading in responsibility AI development and strong data privacy protections. Thank you.